Graham Voss fired me at 9:17 on a Thursday morning, inside a glass conference room, while a red banner crawled across my laptop, telling me my Nexora cloud systems access had been revoked. He said my report on a $2.8 million billing leak was incomplete, outside scope, and never formally delivered. Then he told me Nexora would not pay my final consulting milestone of $58,000. That payment was due in 6 days, and without it I would be choosing between delaying payroll for my 4-person team and draining almost every dollar of my firm's operating reserve. Graham stood at the end of the table in a tailored navy suit, one hand resting beside his steel watch, and spoke as though he were correcting a scheduling mistake. "You no longer have authority to distribute any work product," he said. I looked at the access alert, then at the secure delivery receipt, already saved in my authorized engagement file. Final report, version 3.0, delivered at 8:42, opened by Priya Shah at 8:47, opened by Raymond Ellis, chair of the audit committee, at 8:53. Graham believed he had stopped the report before the board could see it. The board already had it. What I did not know was whether Raymond would treat the executive exception history as a control failure, a financing pressure mistake, or a breach of trust by the founder who had signed every safeguard he was now trying to deny. My name is Adrian Cole, and 12 weeks earlier, I had walked into Nexora believing the hardest part of the job would be finding where the money was leaking. I was 42 then, the founder of Cole Revenue Advisory, and I had built my career translating complicated revenue problems into decisions executives could use. I wore rectangular glasses, kept my beard closely trimmed, and arrived in a charcoal suit, pale blue open-collar shirt, and dark leather portfolio. Clients sometimes mistook calm for softness. They usually stopped after I reconciled their contracts against what they had actually billed. My firm had 4 people besides me: Lena Brooks, our senior revenue analyst, Marcus Lee, our data specialist, Tessa Grant, our project manager, and Evan Price, an associate consultant. We were profitable, but profit on paper did not guarantee cash in the bank. One delayed receivable could still threaten payroll. Nexora Cloud Systems sold subscription software for workforce scheduling, field operations, and customer service. It was privately held, large enough for an independent board and audit committee, but still dominated by its founder. Graham had silver-brown hair, a clean-shaven face, a tailored navy suit, and an expensive steel watch. He was charismatic, capable, and unusually good at making growth sound inevitable. He called after Nexora's cash collections fell behind its sales expectations for 3 straight quarters. New contracts and expansion sales were rising, but invoices and cash were not keeping pace. Some delay was normal. A signed contract was not available cash. The company first had to deliver, bill correctly, and collect. Nexora's gap was too large and too persistent to explain that way. At our first meeting, Priya Shah sat beside Graham in a burgundy blazer, her long, dark hair tied low. She had become chief financial officer 5 months earlier. "We do not need a forensic spectacle," Graham said. "We need a fast revenue assurance engagement before the financing review." Priya refined the question. "We need to know whether the gap comes from sales terms, billing execution, collection timing, or a combination." That distinction mattered. A generous contract was a pricing issue. Contracted service that never reached an invoice was leakage. A correct invoice that remained unpaid was a collection issue. I proposed a 12-week engagement for $192,000, $48,000 at signing, $48,000 after the process map and initial data validation, $38,000 after preliminary findings, and $58,000 after the final validated report and executive remediation session. Milestone invoices were due 7 calendar days after issue. Graham said the large last payment gave me an incentive to finish. "It gives both sides an incentive to define finish," I replied. The statement of work listed our scope, data access, deliverables, acceptance rules, and termination terms. Nexora would provide authorized read-only access to contract, entitlement, billing, credit, and cash receipt records for the prior 24 months and current quarter. We would deliver a process map, control gap register, validated leakage analysis, recovery priority schedule, and executive remediation session. Nexora would have 5 business days to identify factual errors or missing agreed elements. Silence after that period counted as acceptance for payment, not agreement with every recommendation. If Nexora delayed access, the schedule moved day for day unless we documented another change. If it terminated after substantial completion, completed milestones and approved non-cancelable expenses remained due. Priya insisted on one more safeguard. Any validated finding above $1 million or involving repeated executive override of financial controls had to be uploaded through Nexora's secure portal simultaneously to Graham, Priya, and Raymond Ellis, the audit committee chair. Graham objected only to sending working drafts. Priya agreed they would not be sent. I clarified that final critical distribution was part of the deliverable, not an optional courtesy. The portal would record version, timestamp, recipients, and access history. A receipt alone would not prove the analysis, but it would prove what was delivered and when. Graham read the clause twice. I am not planning to hide bad news from my board. We are deciding the route before there is bad news, I said. He signed. Raymond joined the kickoff by video. He was a reserved former banking executive with closely cropped gray hair, a trimmed gray beard, a dark 3-piece suit, and reading glasses. Your independence does not make your conclusions correct, he told me. It makes your process reviewable. Agreed. Then give me work that can be reproduced. Sophia Ramirez entered the engagement 2 days later. Nexora's senior billing analyst was 34, with shoulder-length wavy dark hair, a green blouse, black slacks, and an employee badge she touched when she was containing frustration. She understood the billing platform better than senior leadership, but she never pretended to know contract terms outside her role. Sophia mapped the path from signed agreement to cash. Sales entered commercial terms. Legal attached the contract. Implementation activated products. A nightly integration sent entitlements to billing. Finance cleared exceptions. Billing issued invoices. Collections pursued payment. On paper, the process looked controlled. Then Marcus compared 6 quarters of reported contract value, issued invoices, and collected cash. The lines did not need to match perfectly, but they should have moved in a rational relationship. Contract value rose. Invoices rose more slowly. Cash lagged further. The mismatch survived every timing adjustment we tested. I asked Sophia about a large migration to the current billing platform 18 months earlier. She said legacy customers had moved in 4 waves, followed by cleanup. What does cleanup mean? I asked. Accounts that did not migrate cleanly stayed in an exception queue until someone resolved them. The current queue contained 112 active accounts whose billing records did not fully match their contracts or product access. Some were harmless timing differences. Some reflected valid concessions. 37 showed premium modules active without a matching invoice line. Sophia had raised the issue before I arrived through authorized tickets, reconciliation emails, and exception reports. Several tickets had been closed as commercially approved without a named owner, expiration date, or durable correction. Graham reviewed our first weekly update and urged me to focus on current quarter recovery, rather than reconstructing old responsibility. Older exceptions may not be collectible, he said. That is true, I replied, but the history tells us whether the control is still failing. Prioritize cash, Adrian. Do not turn this into a governance project. His point sounded practical, because recoverability and leakage were not the same. A company could have earned revenue under a contract and still be unable to collect every old amount. Customer disputes, notice requirements, amendments, and commercial relationships all mattered, but focusing only on cash that could be recovered quickly would hide the process that created the loss. It would also leave us unable to tell whether the next quarter would repeat it. Tessa reminded everyone that the statement of work covered 24 months, not only the current quarter. Graham did not dispute the wording. He said the financing deadline required judgment about where to spend time. I understood that argument. My team had limited weeks, Nexora had limited attention, and every hour spent on history was an hour not spent on immediate recovery. The problem was that the old exception tickets were not random history. They were the only map showing how temporary decisions had become permanent operating practice. I could confront him with a rough pattern and risk making the assignment political before the evidence was ready, or I could keep validating through authorized systems until the pattern became harder to dismiss. So let me ask you, what you would have done. Type 1, if you would confront the CEO immediately and force the issue into the open. Type 2, if you would finish validating the evidence before making the accusation harder to reverse. And if you have ever been pressured to soften accurate work, you already know why that choice is not as simple as it sounds. I chose validation. The next records changed the meaning of the entire assignment because they showed that the billing failures were not sitting in one broken migration. They were moving through a chain of exceptions that leadership had repeatedly chosen to tolerate. We began with the contract-to-billing migration because it was visible and testable. Lena selected accounts from each migration wave, not just the ones Sophia had flagged. Marcus compared 5 fields across systems: legal customer name, contracted product package, activated entitlements, billing account, and invoice lines. That simple comparison exposed the first cause of leakage. During the second migration wave, Nexora had changed account identifiers. A parent company might sign one master agreement while separate divisions received service. The old platform handled that relationship through a custom mapping table. The new platform expected each service account to point to a bill to account through a different field. Most customers migrated correctly. Some did not. When the mapping failed, service stayed active because Nexora did not want customer operations interrupted, but the premium charges had nowhere valid to post. The platform created exceptions instead of invoices. The exceptions were supposed to be temporary. Finance would review them, correct the map, and rerun billing. In practice, the queue became a waiting room with no clock. Some items had remained unresolved for 14 months. Our first estimate put migration-related leakage at $1.4 million. Priya challenged it in a review meeting. "You are treating every missing invoice line as billable," she said. "We are treating it as a candidate difference. The slide calls it estimated leakage. That is what the sample suggests." She pushed the printout back toward me. "Then the slide is ahead of the evidence. 3 of these customers renewed after the migration. Their new contracts may have bundled the premium module into a platform fee." She was right. The entitlement data showed the feature. The invoice did not show a separate line, but that did not prove Nexora had failed to charge for it. We needed to inspect the renewal terms. Graham watched the exchange without intervening. For a moment, I wondered whether I had given him the opening he needed to dismiss the entire engagement. I told Priya we would revise the language and expand the contract sample. Candidate exposure, not verified leakage, until we establish the governing price. That evening, my team stayed in a quiet finance office conference room until after 10. The glass walls reflected rows of empty desks. We separated migrated accounts into 4 groups: unchanged legacy terms, renewed bundled terms, renewed itemized terms, and incomplete contract records. The $1.4 million estimate fell to $860,000. It was not a defeat. It was the first reason anyone outside my team could trust the final number. The second cause appeared while we were testing those renewals. Nexora sold premium features that could be activated after the original subscription began. A customer might add advanced scheduling, analytics, or mobile dispatch halfway through a term. Sales or customer success obtained an approved order form. Operations activated the feature. Billing should have received the upgrade through an integration event. Sophia showed us a queue called pending commercial synchronization. This is where upgrades land when the order form and account record do not match exactly, she said. How long are they supposed to stay? Evan asked. 48 hours. The oldest open item was 211 days old. The mismatch was often small. Punctuation in a legal name, a missing division code, a customer account merged after acquisition. But when the synchronization failed, the product team could still activate the feature after an executive approval. Nexora prioritized customer adoption and renewal risk over billing completion. The customer received the service. The invoice stayed unchanged. Who approves activation when billing synchronization is unresolved? I asked. Sophia opened the workflow description. Customer Success Leader, Sales Vice President, or Chief Executive for Strategic Accounts. Does the approval expire? It is supposed to be reviewed monthly. Is it? She hesitated. The queue is reviewed. The approval itself does not always have a separate expiration field. That distinction mattered. A team can review a list and still fail to resolve the exceptions if no one owns the deadline. The process showed activity without control. We sampled 62 upgrade events. 41 had reached billing correctly. 8 were legitimate, no-charge trials. 5 were corrected in the following month. 8 had remained active without a matching charge beyond the approved grace period. When we expanded the test, the verified upgrade leakage reached $740,000 over 24 months. The third cause was not technical. It involved promotional discounts. Nexora used temporary discounts to win competitive deals. A customer might receive 20% off for the first 6 months, after which the subscription should return to the contracted rate. The sales system stored the expiration date. The billing platform stored the discounted price. A scheduled job was supposed to update the price when the promotion ended. The job worked unless someone applied a manual exception. Graham had personally approved exceptions for several high-profile accounts. His rationale was commercially intelligent on its face. Nexora was preparing customer growth announcements and did not want large accounts reducing seats or delaying expansions. A short extension could preserve the relationship while sales negotiated a renewal. The problem was that the extensions were recorded in emails and customer notes, not always in the billing platform with a new expiration date. Temporary discounts became indefinite discounts. No one stole money. No one diverted payments. Nexora simply kept delivering contracted service while invoicing less than the agreement allowed after the concession period ended. Priya asked for a separate analysis of valid commercial concessions versus expired discounts. Do not make the mistake of calling an undocumented approval invalid merely because it is inconvenient, she said. Find the authority matrix in effect at the time. We did. Graham had authority to approve strategic exceptions. The issue was not whether he could approve them. The issue was whether the exception had an owner, a defined duration, and a review trail. In 14 accounts, the original approval was valid, but the discount continued, months beyond the stated period. In 9 more, the record was ambiguous enough that we excluded the amount from verified leakage. Our working total now stood at $2,300,000, $860,000 from migration mapping failures, $740,000 from unbilled upgrades, and $700,000 from expired promotional discounts. It was significant, but not yet $2.8 million. More important, the 3 causes were connected. Each one depended on manual exceptions without reliable closure. Graham's weekly questions became sharper. How much is recoverable this quarter? We are ranking that now. How much is merely historical noise? Nothing verified is noise. Recoverability is separate. Adrian, the financing presentation is in 3 weeks. I need management information, not a museum of process failures. I understood his pressure. Nexora was seeking a major financing round. Investors and lenders would examine growth quality, billing discipline, and cash conversion. A $2.3 million leak did not mean the company was insolvent. Relative to Nexora's size, it was manageable. But it challenged the story that growth had become predictable. I offered to create a recovery priority view as an additional analysis. Tessa documented the request in the changelog. The original scope required a recovery schedule, but Graham wanted customer-by-customer sequencing, with commercial sensitivity scores and proposed scripts. That was more detailed than the statement of work. "We can add it," I said, "but it will require either 5 extra business days or a reduced depth in the executive workshop." "No schedule change," Graham said. "Use your judgment. That is not a change control decision." He gave me a patient smile. "Then call it emphasis within scope." Tessa recorded that no price or schedule change had been approved, and that we would provide a prioritized list using available data, not full customer contact plans. Graham did not object to the minutes within the 2-day review period. That small record later mattered more than the conversation. The remaining $500,000 emerged from credits, but not in the way we expected. Nexora's billing team issued credits when customers disputed invoices or when service problems justified relief. Credits should have referenced an invoice, a reason code, an approver, and an amount. Most did. A subset of strategic accounts had recurring credits labeled relationship adjustment. At first, I suspected duplicate credits. That theory was wrong. The credits were individually approved. The problem was that several were issued after invoices had already been reduced by promotional discounts. The customer received both the lower price and a separate recurring credit. In some cases, the credit was intended to substitute for a discount extension, but billing applied both because the systems did not share the same commercial status. We tested every recurring relationship adjustment above $10,000 and a sample below that threshold. After excluding service-level credits and ambiguous customer disputes, the verified duplicate concession effect was $500,000. The arithmetic was now tangible. $860,000 from legacy accounts whose premium charges failed during migration. $740,000 from approved upgrades that became active but never reached invoices. $700,000 from promotional discounts that remained after their authorized expiration. $500,000 from credits, layered on top of already reduced prices. Total verified leakage, $2.8 million over 24 months. That figure did not include another $620,000 of uncertain exposure. We excluded accounts with missing contract amendments, disputed implementation dates, or approvals we could not classify. I wanted the report to show the uncertain amount in an appendix as potential exposure. Priya insisted the main findings stay at $2.8 million. "Your strongest number is the one we can reproduce," she said. I agreed. We also separated the $2.8 million by stage. About $1.9 million had never been invoiced. Roughly $900,000 had been invoiced below the contracted amount through discounts and duplicate concessions. None of it was the same as collected cash. Some could still be billed. Some would require negotiation. Some was probably gone because of contract limits, customer relationships, or the passage of time. Then, Lena found the executive override pattern. Every one of the 4 leakage categories included records marked strategic retention, launch priority, or customer announcement risk. Those labels were not random. They traced back to a series of management decisions during quarters when Graham was emphasizing customer count and expansion announcements. He had approved keeping service active, extending concessions, or delaying billing corrections so sales announcements would not be disrupted. The decisions were not secret. They appeared in ordinary emails, meeting notes, and workflow approvals. In several, Graham wrote that billing cleanup could follow after the quarter close. The cleanup often did not happen. That changed the assignment. We were no longer looking at isolated errors that happened despite the control system. We were looking at a control system leadership repeatedly chose not to repair because the exceptions helped protect a growth narrative in the short term. The question was no longer whether Graham understood the billing weakness. It was whether he would accept the cost of correcting it before the financing presentation made the weakness visible to people outside the company. The final validation week began with a meeting in Priya's office. Her desk held 3 neat stacks, contracts we had cleared. exceptions still under review, and management comments. She had challenged us harder than anyone at Nexora, which made her agreement more valuable when it came. I can reproduce the migration and upgrade findings from the samples, she said. The discount and credit categories need one more control. Match each exception to the approval authority that existed on the approval date, not today's policy. We already pulled the historical matrix, Lena said. Then show it in the work papers. Graham will argue that you judged old decisions by a new standard. She was not predicting a theoretical objection. She knew him. We added the authority matrix, rebuilt the exception timeline, and tied each verified amount to a contract term, entitlement date, invoice result, and approval record. Marcus created a reconciliation table with 1 row per account month. It did not rely on a single dashboard. It compared what the customer was entitled to receive, what the contract allowed Nexora to charge, what Nexora actually invoiced, what credits it applied, and what cash later arrived. That table also exposed our genuine weakness. One customer segment, regional health service providers acquired through a reseller program, had incomplete source data. Nexora's reseller portal had been retired, and several original order forms were stored outside the main contract repository. We could verify product activation and invoice history, but we could not confirm every governing price. The segment represented about $410,000 of possible difference. We excluded it from the $2.8 million. But the missing records affected our planned executive remediation session because Graham wanted a complete customer-by-customer recovery plan. We could provide a priority list for verified direct accounts. We could not responsibly tell management how to approach every reseller customer without the source terms. Tessa raised the issue in the schedule meeting. We need either the reseller documents by Monday or agreement that the workshop will address control remediation and direct account recovery, with reseller recovery deferred. Graham looked at Priya. Can finance provide the records? Not by Monday, she said. We are still locating archive access. He turned to me. Then finish what you can. We will. The final report can be completed with the reseller segment clearly excluded. The workshop agenda needs to reflect that. Do not reduce the workshop. Your final milestone includes it. The workshop can occur. It cannot include analysis we do not have authority or data to support. He tapped his steel watch against the table once. You are becoming very contractual for someone hired to solve a business problem. The contract is how we agreed which problem we were solving. 2 days later, Graham sent his first round of report edits. Most were reasonable. He asked us to replace systemic failure with cross-functional control weakness. I accepted that. He asked us to distinguish authorized commercial concessions from execution errors more clearly. I accepted that too. He asked us to move the uncertain $620,000 out of the executive summary. Priya and I had already made that choice. Then the requests changed. He wanted the 24-month trend reduced to the most recent 2 quarters, because older operating conditions were not representative. He wanted the executive override appendix removed, because the approvals were commercially valid. He wanted the phrase, repeated deferral of billing correction, changed to customer continuity decisions. He wanted the simultaneous audit committee distribution, delayed until after his financing presentation, 9 days later. I called him, rather than debate by email. Which finding do you believe is factually wrong? I asked. The report creates a misleading impression that management chose not to bill customers. In some cases, management approved service continuation before billing was corrected. That is not the same as choosing not to bill. The report says the immediate purpose was customer continuity. It also says the required follow-up control failed. Then, remove my name from the override history. The approval records identify the approving role and, where relevant, the individual. We can verify every reference. You were not hired to evaluate my leadership. We did not. We evaluated the control path and the documented approvals within the agreed scope. His voice stayed measured. Adrian, I am not asking you to falsify a number. I am asking you to avoid language that causes unnecessary disruption before a financing event. Delay would violate the distribution protocol. Protocols can be managed, not unilaterally after the finding exists. There was a pause long enough for me to hear the air conditioning through the phone. Send me a version without the executive history, he said. We can settle the language after the presentation. I will send a factual comment matrix. Mark any error, provide the supporting record, and we will correct it. I will not remove verified history because it is uncomfortable. That afternoon, Priya requested a formal validation meeting. She did not defend me. She tested the report line by line. For 4 hours, she asked where each amount came from, why each exclusion had been made, and whether the same logic had been applied consistently across customer groups. Sophia joined for the workflow sections. She confirmed how exception queues operated, which teams owned corrections, and when tickets had been closed. When we moved beyond her knowledge, she said so. Raymond attended the last 30 minutes by video. Mr. Cole, can your $2.8 million be reproduced without your private judgment? He asked. The account-level calculations can be reproduced from Nexora's records using the documented rules. Classification still requires reviewing contract and approval evidence. Can every dollar be collected? No. It is verified leakage, not guaranteed recovery. Can every decision be attributed to Mr. Voss? No. Many failures were cross-functional. The report identifies his approvals where they affected the control sequence. Did you complete the reseller analysis? No. Source terms are incomplete. We excluded that segment from the verified total and documented the limitation. He nodded once. That is the answer I expected. Do not improve it for me. By the end of the meeting, Priya approved the methodology and marked the critical finding validated, subject to 2 wording corrections and a final check of 3 account dates. We completed those checks the next morning. One date reduced the expired discount category by $12,000. A separate missed invoice in the migration sample increased it by the same amount. The total remained $2.8 million, but we documented both changes rather than netting them invisibly. The executive remediation session was scheduled for Thursday at 10. The final report was due by 9, under the portal workflow, so participants could review it. At 7:45, Graham's assistant canceled the session, citing an urgent financing call. Tessa immediately requested a new time and noted that the cancellation was by Nexora. Priya offered Friday afternoon. Graham did not respond. That cancellation created the ambiguity he later used. The final milestone language listed both delivery of the validated report and the executive remediation session. It did not say the session had to occur before the report could be accepted, and the termination clause protected completed work if Nexora prevented performance. Still, the session had not happened. I knew he could make that sound like an unfinished engagement. At 8:15 Thursday morning, I opened the final checklist. Process map complete. Control gap register complete. Validated leakage analysis complete. Recovery priority schedule complete. For verified direct accounts with reseller limitation stated. Executive session materials complete. Session canceled by client. Rescheduling requested. Factual comments resolved. Priya's validation recorded in the meeting minutes. I had one decision left. Graham had told me verbally to delay distribution. The signed statement of work required simultaneous delivery of validated critical findings. The report was complete. The portal was available. The designated recipients were fixed. At 8:36, I uploaded version 3.0. I selected Graham Voss, Priya Shah, and Raymond Ellis. I checked the box confirming final delivery under the statement of work. I added a note that the executive session had been canceled by Nexora and that Cole Revenue Advisory remained available to conduct it at the earliest mutually available time. Then I pressed deliver. The portal generated a receipt at 8:42. For 35 minutes, nothing happened. Priya opened the file. Raymond opened it. Graham did not. I revised the workshop calendar, answered 2 questions from Evan, and began to believe the conflict might stay procedural. At 9:13, Graham's assistant asked me to come to the glass conference room. He was already standing when I entered. Priya sat near the far end, expression controlled. My laptop was open in front of me when the red access banner appeared. "Your engagement is terminated effective immediately," Graham said. "Information technology is revoking all access." On what basis? Failure to complete the contracted deliverables, scope overreach, and distribution of an unfinished report. The validated final report was delivered at 8:42 under the agreed workflow. No, you uploaded a disputed draft before the executive session and after being instructed to pause. The instruction conflicted with the signed distribution requirement. The session was canceled by Nexora. We requested rescheduling. You do not decide when work is final. The acceptance process does. His jaw tightened, but his voice remained calm. Do not turn this into a performance. Your access is revoked. You are not authorized to retain or use Nexora information beyond your contractual obligations. Submit an invoice for approved work through Milestone 3. The final $58,000 will not be paid. That amount is due upon delivery and substantial completion. Your cancellation did not erase the work. The work is not substantially complete. Your reseller analysis is incomplete. Your recovery plan is partial, and you failed to conduct the executive session. There it was, his strongest defense, assembled from one real limitation, one documented scope boundary, and one meeting his office had canceled. Priya spoke for the first time. Graham, the access decision should not affect preservation obligations. Legal and information technology will handle preservation. He looked at me. Adrian, return any company equipment and leave the premises. I closed the laptop. I did not attempt another login. I did not ask Sophia to send me files. I did not copy data onto a personal drive. Our contract allowed us to retain the statement of work, our invoices, approved meeting minutes, methodology documents, issue logs, portal receipts, final work product versions, and limited work papers necessary to support our services, all subject to confidentiality. It did not allow us to keep a private copy of Nexora's customer database. The difference between preserving evidence and taking client data was not philosophical. It was operational, and I stayed on the right side of it. In the elevator, I checked the portal receipt saved to our authorized engagement record. Raymond had opened the report before access was revoked. The fact did not make me feel safe. It made the next question unavoidable. What would he do with it? Back at my office, Tessa had already calculated the cash impact. We had enough in the operating account for the next payroll, rent, taxes, and basic expenses. The payroll after that depended on the $58,000 or on pulling money from a reserve I had built for emergencies. This qualified as an emergency. It also showed how weak the reserve was against concentration risk. Nexora represented 46% of our open receivables and nearly a third of projected quarterly revenue. On an income statement, the engagement was profitable. In the bank account, the unpaid milestone was a hole with a date attached. I gathered the team in our small conference room. I told them the contract had been terminated. The final payment was disputed, and no one would lose their job because of the dispute. Marcos asked the question I had been avoiding. Can we make payroll without it? The next one, yes. The following one requires reserve funds if this is not resolved. Lena looked at me carefully. Did they dispute the number? They disputed completion and scope. Graham also disputes how the report characterizes executive overrides. Do we have what we are allowed to keep? Yes. Nothing more, nothing less. That answer steadied the room more than a promise would have. At 4:20 that afternoon, Graham called. I want to resolve this without turning it into a board issue, he said. It became a board issue when the validated critical finding met the distribution threshold. I can authorize $30,000 as a termination payment if you withdraw version 3.0, replace it with a management draft, remove the executive override section, and state that the analysis remains incomplete pending reseller validation and the executive session. You are asking me to retract verified work. I am asking you to describe its actual status. The reseller segment is excluded. The session was cancelled by your office. Neither changes the verified core finding. 30,000 protects your people and avoids an expensive dispute. He knew exactly where to press. 30,000 would cover the immediate payroll gap and buy time. I pictured my team's direct deposits, health insurance charges, and the reserve balance dropping. Professional principles feel clean when they cost nothing. This one had a payroll calendar. I asked him to put the proposal in writing. You are considering it. I document material engagement communications. He exhaled. You always hide behind process. No. Process is the part both sides agreed to before either side needed protection. I did not accept. At 6:11, Raymond emailed both Graham and me. He wrote that the audit committee had received a document represented as the final report, that management disputed its status and methodology, and that no conclusion would be reached until both positions were reviewed. He scheduled a controlled preliminary meeting for Monday. He instructed Nexora to preserve relevant records and instructed me to provide only materials I was contractually authorized to retain. The dispute was no longer about whether billing leakage existed. Even Graham had not said the number was 0. It was now about whether I could prove two things without live access: that the $2.8 million finding was reproducible, and that Cole Revenue Advisory had substantially completed the work required for the final $58,000. I spent the weekend building the case in the only order that made sense: agreement, method, performance, delivery, and independent verification. A portal receipt, by itself, would not carry the dispute. Neither would a polish report. Evidence becomes persuasive when separate records point to the same sequence. First came the signed statement of work. It showed the 12-week term, the $192,000 price, the 4 milestone amounts, the 24-month review period, the data access responsibilities, the deliverables, the acceptance window, the termination protection, and the simultaneous distribution rule Graham had approved. Second came the methodology. Priya had approved the sampling approach after requiring us to revise the first inflated estimate. The meeting minutes showed that we had corrected our $1.4 million migration estimate to $860,000 after reviewing bundled renewals. That mistake helped us now because it demonstrated that we had not forced every anomaly into the largest possible number. Third came performance. We had final versions of the process map, control gap register, leakage analysis, recovery priority schedule, workshop deck, issue log, and factual comment matrix. The reseller limitation appeared consistently in each relevant document. The workshop materials existed, even though the meeting had not occurred. Fourth came delivery. The portal showed version 3.0, delivered to all required recipients at 8:42, opened by Priya at 8:47, and Raymond at 8:53, before my access was revoked at 9:16. Tessa's minutes showed that Graham's office canceled the 10 o'clock session and that we offered to reschedule. Fifth came the payment history. Nexora had paid the first 3 milestones without claiming the engagement was off track. The third payment, $38,000, had been approved after preliminary findings included the same 3 core leakage categories, later expanded in the final report. On Monday, Raymond sat at the head of a smaller conference table than Graham usually used. He wore a dark 3-piece suit and reading glasses. Priya sat to his right. Graham sat across from me, an outside accounting partner, joined by video. Raymond began with Graham. State management's position without characterizing Mr. Cole's motives. Graham did. He argued that the report was not final because the executive remediation session had not occurred, the reseller segment remained incomplete, and the recovery schedule did not cover every affected customer. He argued that I had exceeded scope by framing authorized commercial decisions as executive control failures. He also said I ignored a direct instruction to pause distribution while factual disputes remained. It was a credible presentation. He did not rant. He used the contract language, the missing workshop, and my acknowledged limitation. Raymond turned to me. What is your weakest point? The milestone combines report delivery and an executive session. The session did not occur. Why should Nexora pay as though it did? Because the materials were complete, Nexora cancelled the session. We offered prompt alternatives, and the termination clause makes completed work payable when the client prevents the remaining performance. I am not claiming the session occurred. I am claiming Nexora cannot cancel it and then use its absence to erase substantial completion. And the reseller work? Excluded from the verified total because source contracts were incomplete. The scope required analysis using data Nexora provided. We documented the limitation and did not bill a change order for archive reconstruction. Graham leaned forward. The recovery schedule was supposed to be actionable. It was actionable for the verified direct account population. Your request for customer scripts and reseller-level sequencing was logged as added emphasis without a schedule change. Raymond looked at Priya. Did management object to those minutes? No, she said. Not within the review period or afterward. He did not decide. He ordered a limited independent reproduction. The outside accountants would use Nexora's own systems with Priya controlling access. They would retest the largest accounts, a random sample from each category, all executive exceptions above a threshold, and the timing of report delivery. Sophia would explain billing workflows, but would not select the sample or classify the results. My firm could answer methodology questions, but would not touch the live data. The review took 18 business days. During that time, I funded payroll from our reserve. I also delayed my own draw and postponed a software purchase. I did not tell the team. Everything was fine. I told them exactly what was covered and what remained uncertain. That honesty cost me less trust than false reassurance would have. Priya called twice with questions. In one sample, the accountants found that a premium feature had been deactivated for 2 months, even though the entitlement table showed it active. Our calculation had counted both months. The correction reduced migration leakage by $19,000. In another sample, they found a strategic account upgrade that had been active for 3 months before billing began and had not appeared in our population because the account identifier changed after a merger. That increased upgrade leakage by $22,000. The net difference was small, but Raymond did not care about the net. He cared whether our rules produced consistent corrections in both directions. Sophia's role was equally narrow. She confirmed when exception queues were reviewed, which fields triggered billing holds, and how relationship adjustment credits were entered. Her old tickets established that the weaknesses existed before my engagement. They did not prove Graham's intent. They proved chronology. Warnings had been raised, temporary fixes had been used, and durable ownership had remained unclear. Graham continued to press the reseller weakness. The outside team could not fully reconstruct that segment either. Raymond accepted that as a real limitation. He also accepted that we had excluded it. The missing data reduced the completeness of the recovery plan, not the reliability of the direct account findings. On the 17th day, the accountants reproduced verified leakage between $2,774,000 and $2,831,000, depending on the treatment of 2 contract effective dates. Their central result was $2,804,000. Within reasonable tolerance, it confirmed our $2.8 million figure. The strongest contradiction came last. Graham had written in his termination notice that no completed report had been delivered and that management had stopped distribution of an unfinished draft. The portal version history showed that version 3.0 was marked final under the statement of work, that Priya's validation status had been attached, and that both Priya and Raymond opened it before information technology revoked my account. Graham's own assistant had canceled the executive session after the final delivery deadline, not before the analysis was complete. His written settlement proposal then asked me to withdraw version 3.0 and replace it with a management draft. He could not logically demand withdrawal of a final version while claiming no such report existed. Raymond scheduled the audit committee meeting for the following Tuesday. The boardroom was quieter than the glass conference room where Graham had fired me. Raymond sat at the head. 2 other independent directors attended. Priya had a binder in front of her. Sophia waited outside until called. Graham looked composed, but the steel watch stayed flat on the table instead of on his wrist. I presented for 20 minutes. No speeches. I explained the 4 leakage categories, the excluded uncertain amounts, the reseller limitation, the canceled session, and the evidence of delivery. I said the $2.8 million was revenue Nexora had contractually earned, but failed to bill correctly or preserve through its controls. I did not call it stolen cash. I did not claim all of it could be recovered. Graham challenged the conclusion. The analysis treats growth-oriented customer decisions as accounting failures. Priya answered before I did. The independent review separated valid concessions from expired or duplicated concessions. The issue is not whether management could approve exceptions. The issue is whether approved exceptions had owners, end dates, and reconciliation. He turned to her. And you believe every classification is perfect? No. That is why the review reports a tolerance range. The central finding remains. Sophia was called in for 10 minutes. Raymond asked whether billing personnel had raised the queue problem before the engagement. Yes, she said, through tickets and monthly reconciliation notes. Were those warnings ignored? Some were resolved account by account. The broader control issue did not receive a permanent owner. Did Mr. Voss instruct you to suppress invoices? No. Did executive approvals allow service or discounts to continue before billing corrections were complete? Yes, for strategic accounts. Her precision removed the exaggeration from both sides. Raymond then read the independent conclusion. Nexora had reproduced approximately $2.8 million of verified leakage over 24 months. Cole Revenue Advisory had substantially completed the contracted deliverables. The executive session remained unperformed because Nexora canceled it and terminated access. The audit committee would not treat that cancellation as grounds to deny the entire final milestone. Then he looked at Graham. You told this committee that no completed report had been delivered before access was revoked. I opened the final report at 8:53 that morning. Priya opened it 6 minutes earlier. Your termination notice was issued afterward. Explain the discrepancy. Graham said the document was labeled final by the consultant, not accepted as final by management. That is a dispute over status, Raymond replied. It is not the same as saying no report was delivered. Graham's answer became narrower. He said he had acted under financing pressure, believed premature distribution would harm the company, and considered the report incomplete because the workshop and reseller work remained open. Raymond did not announce a punishment. He said the committee would address executive conduct, financial reporting authority, and remediation after I left. Then, he directed Priya to complete a documented payment review under the contract and to negotiate any remaining expense questions through ordinary channels. 9 days later, Nexora paid the $58,000 milestone plus $3,400 of previously approved travel and data processing expenses. In exchange, both sides signed a narrow resolution confirming payment, confidentiality, return and deletion obligations, and my availability for one remote remediation session. I did not retract the report. Through the permitted follow-up process, Priya told me that Nexora recovered about $1,100,000 through corrected invoices and negotiated true-ups. Another portion was commercially settled for less than face value. Some older leakage was not pursued. The larger benefit was forward-looking. Billing exceptions received named owners, expiration dates, weekly aging review, and audit committee reporting above defined thresholds. Graham lost unilateral authority over financial reporting exceptions. His bonus was reduced, and the board issued a formal reprimand. He remained chief executive during the remediation period and ultimately resigned after the company completed its financing under tighter oversight. Nexora did not collapse. It became more disciplined. The payment protected my team's payroll, but the experience changed my firm. I capped any single client at 25% of projected receivables. I built a larger cash reserve. I separated report delivery from optional workshops and future milestones. I added termination payments tied to completed work, faster acceptance checkpoints, and explicit change control language when clients requested deeper analysis without more time or price. I also stopped treating a signed contract as a substitute for cash planning. Revenue, invoices, collections, and available cash are different stages. A profitable consultancy can still be fragile when one client controls too much of what it is owed. The larger lesson was not that every billing error is fraud or that every board will side with a consultant. Contracts, accounting treatment, and governance procedures vary by company and jurisdiction, and this story is general education, not professional advice. The lesson was that accurate work needs a route through resistance, defined scope, reproducible methods, authorized records, clear acceptance, and a distribution path agreed before the facts become threatening. Every contract has a consequence. Facts become leverage only when the path for delivering them was built before the conflict began.